You're listening to 2025 The Final Drive, What You Need to Win with David Hayes.
Thank you. Welcome to podcast 16 of 2025, The Final Drive. What you need to know to win. Of course, a number 4 daily bestseller on Amazon. Very proud of that. A lot of speaking engagements recently. So if you're an employer and you would like me to come speak to your group, I'd be happy to. Complimentary, free of charge, because I am on a mission to spread the word that tax rates are to expire at the end of 2025, giving everyone a real opportunity to act now to save ourselves from taxes destroying our retirement accounts before they go up for good. Of course, 2025 is the metaphor on my football playing and coaching days. With the metaphor, it is time is ticking, time is running out, the time to go is now. I covered that in detail in episode number 1, and I just pulled those all up online. They're pretty coolly laid out. I'd start at the bottom, just go straight through. For a while, you kind of need to listen to one before you listen to the next one, but then once you get a little further along, you can jump around. In today's podcast, I wanted to talk about tax-free bonds. And are they really tax-free? Well, sometimes yes and sometimes no. Let's talk about who issues them. Most of the time, it's some form of a municipality. So a city, a county, a state. They issue debt to build a bridge, to pay for some project. And for the most part, they are tax exempt at the federal level, but then also at the state level if it's a bond issued by that state. Now, not every state follows that rule. In fact, the state I'm from, Indiana, changed that rule a few years ago where you must buy an Indiana bond for it to be tax exempt in Indiana. Prior to that, any bond was tax-free in Indiana. That was a pretty good deal, right? Well, they're not all tax-free. Sometimes there's called taxable municipals, so you have to keep an eye out for that. That's fairly uncommon, but it is certainly something to keep your eye on if you are a tax-free bond purchaser. Now, they are typically issued in a pretty long increment, so maybe 30 years with some type of an interest rate that is contractual, and it is, again, mostly tax-free. But what about zero coupon bonds? These don't get a lot of notoriety, but I love these things. If you don't need the current cash flow from your bonds, in other words, I don't need the interest payments, I'm going to let it ride anyway, zero coupon bonds can be a great value. You actually get them at a discounted rate. So let's say that you own a bond that's worth $10,000 at maturity. You go buy it at, let's say, 70 cents on the dollar, and each year that goes by, that bond will slowly accrue to 100 or 1,000. And then that is called a zero coupon bond. For giving up the coupon, you typically get a little better, quote, rate. You're not getting paid a interest rate per se, but the interest rate is calculated based on the discounted rate. So it's something to look into for sure. What about I-bonds? No one wanted I-bonds when there was no inflation, but now we have inflation. Everyone's talking about them. Currently in 2022, you can get a rate somewhere between 7 and 9.5%, at least for the next 6 months until the next reset date. They are tax-free at the state level, and the issue is you can only buy $10,000 a person. So it's not a big place to park a lot of money, and you must hold them for 6 months before you can sell them. If you sell them within the first, like if they sell them within 1 year, you're gonna give up some interest, like a half a year. And if you don't hold them at least 5 years, you're going to give up some interest as well. So there is something there to be had, but also something to be aware of. Now, when are tax-free bonds not tax-free, right? Well, let's say I buy a bond for $10,000 and interest rates go down, credit quality goes up, whatever. The bond's now worth more. Maybe it's worth $1,100, $1,200, and I say I'm going to sell it. Well, that is considered a capital gain. So it is not tax-free. The capital gain is a capital gain. And it works the other way as well. If I sell it at a loss, the loss is a capital loss that I can use to offset other gains or carry those forward to offset future gains. So they work that way, and they're not completely tax-free. The interest, again, is tax-free, but the sale of the asset may be a loss or a gain. The other reason I say they're not completely tax-free, if you're retired, the income that you receive from a tax-free bond goes into the calculation to determine how much of your Social Security is taxable.
Securities are offered through J.W. Cole Financial, member FINRA and SIPC. Investment advice offered through CFCI and J.W. Cole Advisors. J.W. Cole Financial, J.W. Cole Advisors, and CFCI are unaffiliated entities. The opinions expressed by David Hayes and his guests should not be construed as specific investment, legal, or tax advice. All economic and performance information is historical and is not indicative of future results. Investing may involve the risk of losing principal. Any tax advice on this show is not intended to be used by any person for the purpose of avoiding U.S. federal or state tax. Penalties may be imposed on such a person, and each listener should seek advice from their tax advisor or legal counsel on topics that arise from the show. David Hayes and his guests are not providing legal or tax advice. Nothing should be construed as solicitation or an offer to buy securities.